think that's going to work. Good to see you all, many of you, to see you all again. What do you want to talk about today? What are the things you want to hear? Global economy, yeah, but what specifically? Are there any things that you want me to talk about particularly? Do you want to be scared? Yeah. All right, so there's plenty of scary things happening in the global economy. Do you want to hear all the scary stuff or the good stuff? Scary, all right, scary stuff, Peter?
When you lectured us, you sort of said that China was on a 40-year growth thing, but it could have hiccups, and I just wondered about the hiccup.
Good man. So China's hiccups, all right, I'll definitely pick that one up. I don't know if you've had a chance to see the Financial Review today, but there's a nice article in there about the bulls versus the bears on China, and I'll talk about that. But Michael Petit is a very well-known bear on China, and he's of the view that China is in the latter stages of this credit-fueled boom, and that boom will end very badly, as a lot of other credit-fueled booms have ended in the past. On the other side of that, there are many bulls who are arguing that, no, this will just be a little hiccup. China will slow down to 7% or 7.5% and keep going for the foreseeable future. So I'll talk about a few issues around that. Anything else? A few other issues we want to pick up on? Yep. Yeah, Australian economy. I guess I have to talk about that. So I will talk about that.
Would be interested to know how the various world economies are reacting to some of the positive news that is coming out from US, although there might not be that much positive data, but they're still taking steps to react to that, and when things actually change in US.
Yeah. So certainly the US is still a major global economy, the biggest global economy, the major driver of global growth. So the US is very important, and I won't give you all the answers now, but I'll argue that essentially the US is in a much better place than the other European G7 countries and Japan. And it's in a much better place for a number of reasons. Partly policy's a little bit better in some ways, but also they've got a demographic advantage over countries like Germany and France and certainly Japan. Yep. Yeah, so this is Australia and the transition, or whatever they're calling it, and away from mining. And of course, now we're all having to live in Darwin because Kevin Rudd is going to shift us all up there. So the transition will be a transition to a warmer climate and all those types of things. Yeah. Yeah, so Abenomics is something I want to talk about because I think it is a really interesting one. All right, so give me a few ideas. I might stop a little bit through the talk and see if you've got any other things that you want me to go back through or pick up on. But it's good to hear that you're wanting to hear the things that I was mostly planning to talk about anyway. Now, I don't know why this screen is not working, but projector 1, projector 2. Right, okay. So I thought I'd also talk about some sort of couple of big trends globally. One is the rise of Asia. The government wrote the Asian Century White Paper late last year, and I don't know, has everyone read that? Oh, sure. Yeah, it's about 300 pages it's a propaganda piece really, and essentially saying that Australia needs to lift its game and we need to have higher productivity if we're going to compete in the Asian century. But it doesn't actually say how we might do that. So it's not very useful in terms of thinking about how we position ourselves in the Asian century. The thing that it does well in that paper is document the sort of trends that are happening globally and particularly in Asia that will affect all economies, but especially us here. And so I want to pick up on some of those big trends as I go through the talk. And the other thing that I want to talk about is demographics, and I'll come at this in a couple of different ways. But to me, we don't think enough as economists or as business people about demographic change because it happens slowly. In our lifetimes, it's sort of something that happens quite significantly from the beginning to the end of our lifetime. But in the course of a year or 2 or 5 or even 10 years, demographic change only influences the economy a little bit. But over long periods of time, over generations, demographic change has major impacts. And Japan is an example that I'll talk a little bit about today, where demographic change has been managed very poorly. And I guess I'm hoping that most other countries don't fall into some of the traps that Japan has fallen into. So demographic change has major implications for economies, but also, of course, it has major implications for businesses. We are going to be living in a world where people are older, so there are lots of opportunities in areas like health and so on, but also lots of challenges. And so they're, I think, worth thinking about, and something, again, I don't think we think enough about. All right, so, and I thought I'd do it sort of geographically. So I will talk about Japan and Abenomics, China, the US, Europe, and then I'll finish on Australia, and perhaps that's a good point to bring in other questions as well. I think I've told many of you before that I'm quite comfortable on talking about certainly big picture macroeconomic issues around those countries. If you ask me questions like some of you do in the class about, the Kuwaiti economy or something like that, then I have no idea. Do have a bit more of an idea about Singapore and the UAE and some others, but as a result of the last year, but I'll leave it at that. Now, this is not quite as sexy as Hans Rosling's moving graphics in terms of the bubbles here, but I'm doing the same thing as what he does, where what I've got here is the percentage of the global population on this axis and the percentage of global GDP. This is Angus Maddison's data, well-known economic historian. This is the PPP data, so it kind of overstates a little bit Chinese incomes and emerging economy incomes. But no matter how you cut it, the story I want to tell here is the same. And the story is that at the beginning of the 20th century, Western Europe was the dominant player in the global economy. A bit more than a third of global GDP. And again, that's probably understated because this is the PPP-based measure. But Western Europe is at the heart of the global economy, twice as big as the US, much bigger share of the global population, at that time about 15% of the global population. And I can't tell you what the global population was, but it was 15% of it. Asia, with 55% of the global population, had about a quarter of global GDP. The interesting thing about Asia is that between 1900 and 2050, when, well, that's 2050 is the last United Nations population projections that I've seen, the share of the global population housed in Asia doesn't change. It's between 54 and 57%. So we've always had the majority of the global population in Asia, but what's happening through the course of the last 20 years is we're starting to see the share of global GDP in Asia catching up to their share of global population. So if we go from 1900 to 1950, not much changes. China actually is a little bit worse due to the fact that they had a very poor first half of the 20th century, a pretty poor sort of third quarter as well, but they came roaring home in the last quarter. They were only about 5% of global GDP, with about a quarter of the global population. India in 1950 had a much smaller population than China, but it was almost trivial in terms of global GDP. Japan, basically it's 3%. 3% of the global population, 3% of global GDP. And you can see Western Europe has fallen back and the US has started to rise again.
Asia, is that including China, India, Japan as well? That big blue one?
Yes, it is. Sorry, yeah, it is. By 1980, China and India haven't moved much. They're still down here. They're still only a small fraction of global GDP. Population in India has started to increase in terms of share. But the main action is with Western Europe continuing to slide. So it continues to slide both in terms of population and in terms of global GDP. So down to 15% of global GDP by 1980. And Asia, again, still 55% of global population, but 25, 26, 27% of global GDP. What we've seen since 1980 is China has reformed its economy. India started to reform its economy. Japan and Western Europe have started to get hit by demographic change and by other factors that have weakened their economies. And we talk about other economies like Brazil, which are starting to rise. And if we flip to today or to 2008, Asia is off the chart in terms of percentage of global GDP. So that, again, that's overstating it a little because it's PPP based, but Asia is very much catching up to its share of global population. So whereas at the beginning of the 20th century, Europe and the US was where all of the action was in terms of the global economy, in this century it's all about what's happening in Asia. And Western Europe has continued to slide, and what's happening right at the moment is making their slide even quicker. I don't know if you saw the data out this week, I think it was on Friday, that the EU is out of recession. So I think they've had 6 quarters in a row of negative growth, and they just had growth of 0.3% in the last quarter. So a fantastic outcome. Actually, it's a terrible outcome. But again, Western Europe is sliding. It's not doing very well for a number of reasons that I'll talk about, mostly because I'll talk about the same sort of things happening in Japan. In 2008, Japan is about 6% of, it's actually about 7% of global GDP, and it's about 3 or 4% of the global population. Japan's going to sort of slide away, both because its population is falling and because its economy is so weak. And so the interesting questions are about countries like Brazil, India, Indonesia, the extent to which they will sort of shift up in terms of global weight. But the shape of the global economy has changed very dramatically in the last 25 years, basically because of reform in China and India and other parts of Asia that have meant that their economies have started to do what they were doing 200 or 300 years ago. They were then very important parts of the global economy, even though I guess the global economy in terms of linkages was pretty small. And I've got a slide there. I'm happy to have these slides distributed. These are just the projections from the United Nations in terms of population and from Angus Maddison in terms of shares of global GDP. So the further you go out to 2030 or 2050 where his I would say guesstimates at that point end. And Western Europe is 5% of the global population, 13% of global GDP. I reckon it will probably be less than that in 2030. And the US is only 17% of global GDP. China and India, certainly China, is a much bigger economy at that point. And I think most pundits are expecting China's economy to be bigger than the US by about 2025 or thereabouts. Yeah, what is Africa now? Africa is 15% of the global population now and 3% of global GDP. And so the interesting thing is, why isn't it catching up in terms of share of global GDP? So to be honest, I think that's probably a little bit too pessimistic, but and I think also these are Maddison's estimates of the economic size. I don't know how much he's got the sort of population forecast built into that. So he may have. One of the interesting things, if you look at the shape of the world in terms of population, is that in 1950, Asia's 55% of the global population. What's Western Europe and the US? 20%, 18%. By 2050, Western Europe and the US are down to 8 or 9% of the global population. Africa is nearly a quarter of the global population. So that's a huge shift. And in terms of international institutions and so on, I don't think we've really got our mind around that. All of our institutions, the IMF, the World Bank, at least our economic institutions, were set up at the end of World War II, when those economies were very important and when they were big players in terms of global population. So this is a big change, and we already know about this because we're talking about the Asian century and we're talking about the rise of Asia. But the numbers are not just bringing home the point that this is a force that's well and truly underway. Okay, so let's go to an Asian economy, and the most developed, but the economy that's doing the worst is of course Japan. So it's worth talking about Japan because some of the things that are happening in Japan I think are a warning to certainly Western European economies, but ultimately to Australia as well. As I've mentioned, Japan has managed demographic change and just sort of general weakness in their economy very badly. And so the question is, why have they done so badly, and what have they done in the past 20 odd years? Japan is still a very important economy. It was the world's second largest economy until 2010 when China took over. It was our largest trading partner until 2007 when again China took over as our largest trading partner. And so we all, 25 years ago, were talking about the Japanese model in terms of corporate structure, the Japanese model in terms of economics. But now we talk about Japan as a kind of lesson as to where things can go wrong. Japan has been in more or less continual recession since 1990. So they've had, on average, as I'll show you in a moment, about 0.9% GDP growth per year since 1990. The story with Japan starts with the collapse in asset prices. So I've updated, should have been able to find a more recent stock market one, but you guys probably know the numbers better than me. The equity, the Nikkei is about 12,500, so it's about where it was when my graph ends there as of the last time I looked. The land price index that I've got on the top there is a residential land price index, down about 60% since 1990. And if you look at commercial property prices, they drop even more. So there's a couple of points about both equity markets and property markets in Japan. One is the size of the drop, the huge drop in prices. But the second thing you notice from the graphs there is that in both cases, I mean, equities and property prices fall a lot at the beginning of the 1990s, but then they just keep on falling. All right? So the first part of the fall is the popping of an asset bubble. So in 1990, the Nikkei is at at nearly 40,000. The PE ratio was about 60. In terms of real estate, the story is that the Imperial Palace in Tokyo was worth more than Manhattan Island. So these are, ex post, classic examples of bubbles. So the bubble pops and prices fall 40, 50% in the space of 12 to 18 months. But what happens then is you've got weak demographics, confidence, all kinds of other factors that just keep the slide going with disastrous consequences for the economy. So how does these equity price falls and property price falls affect the economy? Right, you guys, or some of you did my classes, you remember that we can carve the economy up into these pieces. We can look at aggregate demand. And in terms of the impact on the economy, weak property prices mean that people's wealth is destroyed, so they're not going to consume as much. So it affects consumption growth. Also in Japan, there's a lot of cross-shareholdings. So corporates have shares in one another, and banks have shares in corporates and vice versa. So the equity price falls weakens balance sheets, and what does that do? That affects investment. So the initial effect of these asset price collapses is very weak aggregate demand, especially on the private side, consumption and investment. Okay, so then what we get is this ongoing weakness, which means that it takes a long time to clean up balance sheets, and you're getting further falls in wealth. So the wealth effects from this on the economy are not good for a long period of time, for basically the whole of the last 20 odd years. Things started to pick up a bit in 2005. Especially you can see that clearly with equity prices, you can see it a little bit with property prices. But then of course the global financial crisis hit and it's all gone pear-shaped again. And the reason things started to improve in 2005 is they did do a number of reforms that were very helpful in terms of economic outcomes around about 2005. Until 2005, there were lots of banks that still had basically disastrous problems on their balance sheets. And those banks weren't properly restructured until 2005. So there were some good things happening there around the middle of last decade, but it's all got ugly since then. So this is what happens after the bubble bursts. I've already mentioned this. Weak construction activity, of course, because of property prices being so weak. Zombie firms, again, any of you who've heard me speak about Japan will have heard me speak about zombie firms in Japan, and I've written a little bit about that as well. So the stories, the classic stories are things like retailers, Dai, which was bailed out by the government a couple of times, multi-billion-dollar US dollar bailouts. It's a retailer. Why do you bail out retailers? We know we bail out car firms, and apparently we've got a new plan for doing that, but not quite sure why you might bail out a retailer. So the retailer's bailed out. Because they're bailed out, their bank keeps giving them loans because they think, well, they'll be bailed out, so we can afford to do that. But the problem is when you've got a company that should be going out of business, you've got other competitors in that space who don't have funding from the government, who don't have sort of cheap loans from their bank, but who can't compete because you're still in business. So these zombie firms in retail, in agriculture in particular, in other sectors of the economy mean that there's less competition, there's less productivity across the economy. And the way Anil Kashyap at Chicago Business School characterizes this is that the domestic part of Japan's economy is very inefficient, very unproductive, full of zombies, whereas the internationally competing firms, the Toyotas, Sonys and so on, have to be competitive. They can't be zombies because the international playing field won't let them. And so there's this sort of division in Japan between zombie firms in the domestic side, the rice farmers and all those types of players, and the internationally competitive and productive export-oriented firms. But the problem is export as a share of Japanese GDP is only about 20-odd%. I can't tell you what share of employment exporters provide in Japan, but they're not the majority of the economy. So you've got the majority of the economy being propped up and basically zombies. So they're called zombies because they walk around, drip-fed, kept alive, but they should be shot. So since 1990, there's been lots of efforts to stimulate the economy using fiscal or monetary stimulus. Some people, Paul Krugman, argues they've never tried hard enough with fiscal policy. I'm not sure that's right. And I'll come back to that in a moment in terms of the latest policies. And also, I think where probably Krugman and others are right is that there has been monetary stimulus, but it hasn't really been very aggressive. Japan has had deflation for most of the last 20-odd years. So I think the one arm of current policy that's likely to be helpful and work is the fact that they'll have proper monetary stimulus. But that's only sort of one leg of the stool. That's not going to really get the economy moving. These are the numbers in terms of Japan's GDP growth in the last 23 years. So the blue line is GDP. It's all in 2,000 Japanese yen in trillions. And GDP's on the left scale here. So GDP's risen from 110 to about 125 in 23 years. On average, have I got the average growth there? I haven't got it there, but I think it's about 0.9%. Okay, GDP growth. By comparison, in Australia, you'd be looking at about 3.5% over that period. In China, you'd be looking at 10.5%. Now, obviously, there are differences in those economies, but Japan should be close to Australia, or at least within about 1 to 1.5% of Australia. So it should be more like 2.5%, which would put it up at about 180, 190. So the output gap, the distance between where Japan is and where it should be is very significant.
It's the political landscape in Japan. You know, we get very short-term governments, we get changes of government all the time. Is that driving a lack of decent policy to stimulate the economy? Is that a major issue for that country?
Yeah, so let me come back to that. I'm sure there are some of you here who are more expert on Japanese politics than I am, but I'll give you my take on what's going on now and how it's different because some of the political constraints have eased up, but why I'm sort of worried that it still won't work. Yeah. So the other lines on the graph here are the components of GDP. So the pink line is government expenditure. We know that's been increasing. I think that's on the right scale, and it's grown by 2% a year. Might not sound like a lot, but it's much faster than GDP. And net exports as well. Exports have grown by 4.6% a year, imports by 3.6% a year. So those exporters have been doing very well. Without them, the Japanese economy would be really quite ill. But the problem in Japan is the black line, which is private investment. So private investment is 25% lower than it was 25 years ago, 23 years ago. 25% lower, not higher. So don't worry about growth rates, that's just terrible. In Australia, investment over that period has nearly tripled. Now we've had population growth or workforce growth. Japan hasn't had as much, but over that period in Australia the workforce has gone up by 50%, in Japan it's gone up by 10%. So that kind of reduces the gap a little bit, but it's still the case that in Japan workers have less capital to work with than they had in 1990. Whereas in Australia the average worker has 50-60% more capital to work with than they had in 1990. And Australia would be typical of an OECD economy outside Western Europe. Okay, so that lack of private investment is the real problem in Japan. You have to have private investment. Private investment is where firms are doing stuff because they believe in the future of the economy. They're building businesses, they're putting in place the capital to build those businesses. Right, so in Japan that hasn't happened in the last 23 years. So you can do whatever you like with monetary stimulus and with government spending and so on to try to get the economy going, but it won't work unless investment starts to grow. Once investment starts to grow, then people will get confidence and then consumption will grow and the economy will grow at more normal kind of rates. But that lack of investment is both a reflection of the weakness in the economy and a cause of weakness in Japan's economy.
Does this have inflationary effects?
And well, it has inflationary effects, but it's deflation because the lack of demand in Japan means that it's a weak environment as far as inflation goes. So the deflation that's occurred in the last 20 odd years has been largely about weakness in aggregate demand. Yeah. Okay. Now there's a couple of issues here for Japan that again other countries are going to have to deal with, but Japan is ahead of other parts of the world. Demography in Japan is well ahead of other countries. So where did I get this from? I think the data is from the United Nations. So the Japanese population, I don't know if the population is already falling, but the workforce is falling. And if it's not already falling, it will be soon. We know that by, I think it's 2060, the Japanese population hits 100 million from 128 million or something now. And you know, by comparison with Australia, doubling, I guess, by about 20, I didn't check the number, but it must be about 2150 or something. The year late in the 2100s, when your grandkids are around, we'll have a big population than Japan. The other thing that's happening in Japan is the age profile is bowing out. I don't know if you've seen these age profiles, but 30 or 40 years ago, most countries had pyramid-shaped age profiles that were a little bit wider at the bottom than the Australian age profile. Now we have an aging population, so you've got fewer young people as the fertility rate declines. And most countries in 2050, certainly in Asia, will look like this, with the exception of China, will look like this, where there's a fairly even distribution of people by age until you get to about 75 years old, where people start to die off. But in Japan, you've got this huge bunch of people in the age group 60 to 70 plus. The workforce between today and 2050 drops by 40%. So that has massive implications for the capability in terms of production.
Can I ask you something about that?
Yep.
A bit about that in Japan, the female eligible country workforce just isn't in the workforce, and that the infrastructure is not set up in order for women to be able to go back to work with their parents' families, and just culturally and also just in terms of childcare and stuff and the cost of that. It's just, and then I think it's the chief analyst from Goldman Sachs who's been very much pushing that.
Yep.
Recently and talking about how that might make a difference to the economy.
Yep. So there's a few ways this can be kind of undone to some extent. So Japan has a very low female participation rate. Has obviously very low rates of immigration, which is part of the reason the population is falling, and part of the reason why Australia's population is increasing. So they could undo some of that. I guess in the next 5 years at least, I'm not optimistic that they will do the things necessary to start to raise things like female participation. But let me come back to that in a moment because I've got some examples of that. Did you have a question too?
Same question around immigration.
Yeah. Okay, so demographic issues are a major challenge for Japan. Now, so there's a new so it's kind of like Australia. We've got a new old Prime Minister in Japan, Shinzo Abe, who was the Prime Minister before, and he's come back. And he's got a lot of political power. And again, some of you may know more about Japanese politics than I do, but he has a lot more power than those traditional one-year Japanese prime ministers and Japanese governments. So he has a lot of ability to change policy. He's still having to deal with lobby groups and all those other things, which I think will probably constrain what he does, but we'll see. He's been quite aggressive at saying we need to make significant changes, and he has some plans for doing things that will significantly reshape Japan's economy. But I don't think they'll reshape Japan's economy enough. So I'll talk about the three arms to Japan's policy. It's been called the three arrows of Japan's sort of reform program. The first arrow is much more aggressive monetary policy. So the objective here is to get inflation up to 2%. So the average inflation rate depends whether you look at CPI or other measures of inflation, but the average inflation rate's been negative in the past 23 years. And that has a drag on the economy of itself. The average firm is expecting prices to fall. Consumers are expecting prices to fall. So that has a negative impact on the economy. The objective is to get to a 2% inflation target within 2 years. And they're doing that through what's called quantitative easing, which the Japanese Bank of Japan has been even more aggressive than the Fed or the Bank of England in their quantitative easing. They've been aggressive in the sense that they're aiming to double the money base, but they're also, the central bank is buying corporate bonds and I forget what else, but they're not just buying government bonds, they're buying all kinds of stuff to take crappy assets off banks' balance sheets so that the banks will lend. That's the objective. All right, so the objective here is to significantly increase the money supply, significantly increase lending, and increase inflation to 2% a year. So doubling the money base, that's a pretty interesting experiment. I think this will work. I think this objective will probably be met. They will get to 2% inflation. At the end of the day, if doubling the money base doesn't work, they can triple or quadruple or whatever till they get to 2%. So I think the fact is they'll get to 2% inflation. And that's not a bad thing. That will help the Japanese economy. But it's not the silver bullet, as I say there. The most recent inflation numbers have been positive, but it's all about energy prices. And that's because of the Fukushima, the power issues that have arisen since Fukushima, the disaster there. So it's not clear whether this current inflation being positive will remain, but at least it's in the right side of zero, if only just on the numbers that I've got there. Yeah.
So I was just wondering what productivity in Japan looks like.
Yeah, so productivity, multi-factor productivity is flat over the last 20 odd years. So again, if you compare it with Australia, our productivity growth is about 1% a year. So they've had more or less zero in the last 20 odd years. So a lack of productivity is a problem. That lack of productivity is reflecting the fact that you've got good productivity outcomes in the exporting firms, but no productivity on those domestic firms. Yeah, it is. But then it depends on the exchange rate in terms of international competitiveness. Yeah. Okay, so that's the monetary leg of the stool. And as I say, I think that will achieve its objective, and that will help Japan's economy at least a little bit. The second leg of the stool is infrastructure or government spending. And again, quite dramatic plans here. So fiscal stimulus of 2% of GDP roughly was announced early this year. Half of that spending on infrastructure, and the plans for coming years are for similar sorts of things. Very significant expenditure on government expenditure more generally, but a lot of that expenditure in the infrastructure area. So again, we would think that might push the economy along. It's the 16th large infrastructure package since 1990, so they have tried this before. Now, the big problem with this is in Japan, the government, in terms of tax revenue, raises enough revenue to pay interest and pensions. That's it, right? So the rest of the money they spend, they have to borrow to spend it. And this is a big problem for Japan. So what I would say about these types of programs is if we do this in Australia, I think it would work pretty well. It would really stimulate growth. The infrastructure would likely lead to private sector productivity. And as long as that sort of balance of public debt to the productivity of infrastructure was reasonable, we'd get reasonably good outcomes out of this type of program. But in Japan, there are two problems. One is debt. So the debt levels are 230, depends on the numbers you look at, 215, going to 250% of GDP. So very high gross public debt levels. Sorry, is it what?
Isn't that just, I mean, that's really, really, really high.
It's very high. This is to me the critical issue in the global economy at the moment, because Japan's on a knife edge. And if they get these reforms through, they kind of slowly start to turn that economy around, and maybe it's sustainable. Maybe you're right, maybe they're already past that. But if they don't implement some of the other reforms, the most important reforms that I'll come to in a moment, then I think they're stuffed. They are, as you say, a fly waiting for the windscreen.
That elderly population, they've been keeping interest rates down because they're happy to put their money in almost 0% in
Yeah,
bonds.
yeah.
But when they all go, what happens to interest rates? And that
Yeah, yeah. No, I gave a talk on Japan at an investor conference on Thursday, and you guys know my sense of humour a bit better than the audience there. So I started off by saying that Japan is, to me, Japan is like your grandmother. She's old. She used to work really hard, but she doesn't really like to do very much anymore. And the outlook for the next 20 years probably isn't that good. But so that's basically agreeing with you. A different way of saying the fly about to hit the windscreen. And again, the problem in Japan is that for its economy to grow, this government-sponsored infrastructure spending has to support private investment. And the problem there is we all know about the Japanese bridges to nowhere and things like that. These two slides show, on the left panel, these two panels show infrastructure spending between 1992 and 2001 as a percentage of GDP. So not surprisingly, China has a massive share of its spending on infrastructure over that 20-year period. Japan is the second highest, and so again, reflecting these past infrastructure programs. But because Japan started building infrastructure a long time before China, if you look at the stock of infrastructure, and this data is from McKinsey, if you look at the stock of infrastructure, in terms, and it's broken down by roads, rail, and ports, and so on, then Japan's stock of infrastructure is already massively above other countries in terms of percentages of GDP. So where's China? So China's about the average of these countries that McKinsey looked at. 76% of GDP is the value of the infrastructure stock in China. Now, I take two things from that. Firstly, when we come to talk about China, China's growth is still very investment and infrastructure dependent, and I think it's getting to the point now where that's a bit of a problem. But at least in China, it's probably still got some need for infrastructure, certainly in some areas like airports and so on, and therefore the infrastructure that is built is likely to be reasonably productive. But if we're talking about Japan, the size of the infrastructure stock is already so significant that the productivity implications of more infrastructure are likely to be pretty minimal. Right? So that infrastructure is not what Japan needs, in other words. It's not going to support private investment and get their economy moving. Right? So to me, the way that Japan could get out of its difficulties would be to reform its economies in ways that have been proposed in what's been called the third arrow. So the way the third arrow has been structured is that Abe, when he got to power, announced that he would set up some committees who would make recommendations to him in terms of what other reforms needed to be implemented in Japan. And so let me tell you about a couple of those reforms. They're still underway in terms of which reforms will be implemented and what those reforms will actually look like. There's a couple of really important proposed reforms. In agriculture, in trade, China has asked to join the Trans-Pacific Partnership, which is a free trade agreement, and that will do things like open up Japan's agriculture, but also open up other parts of Japan's economy. So that's a part of the reform agenda that I think will be very important in raising competition and productivity in Japan's economy. But we'll see where that goes. Countries can join trade agreements and then still kind of fudge on the rules. So we'll see where that goes. Farmers are a very important lobby group in Japan. They're also very old. The 83% of farmers in Japan are over 60. More than 50% are over 70. So it's kind of surprising that the government worries about them, right? They shouldn't really be working. But they're voting, right? And they're basically the median voter. So the government is going to look after them. The Trans-Pacific Partnership, a free trade agreement, is one area of reform. Labour market reform. So things like trying to make it easier for females to enter and continue to participate in the labour force. In Japan, it's very difficult to fire people. And of course, you need to have some protections for people who are fired. But I didn't bring my notes, but in Japan, there's been this scandal over these rooms. Who speaks Japanese? Anyone? Oh, rats. Okay. I'm going to get Oibeshi Deyu, is that right? The banishment rooms? You don't know? There's a scandal, and I forget what the Japanese there's a scandal. I forget what the Japanese words are, but the scandal is about these rooms. So there was a government investigation of this. These rooms where you put people who you can't fire but you don't want to work anymore. So you put them in a room hoping that they get so bored that they quit. And the point is, it's so expensive to lay people off that companies can't do it. And as economists, we know that the problem when you can't lay people off is you don't hire people. So the Japanese unemployment rate is actually quite low, but a very large fraction of the workforce work part-time. Firms aren't willing to hire new workers, either young workers or women. They'll hire them part-time rather than hire them permanently because everyone is so hard to get rid of. And that is a reflection, that was the way things were in 1990 when they had this system of you get employed for life and the economy looks after you and does well and firms do well, and that's the way things are. But that's not the way things are today. So one of the committees that Abe set up proposed that they make it easier to fire people, but that was deemed to be too hard. So basically, and I was talking at this presentation the other day, the other presenter was from Macquarie Bank, and he said that they have this issue. They've got an office in Japan where they put people, just in the hope that they'll eventually leave, because it is so costly to lay people off. So labour market reform is a critical area for reform in Japan's economy. And there's other areas where there's lots of opportunities for reform. In health, they've just approved plans for online drugs and things like that. But it's these reforms to Japan's economy that are going to be critical. And if they don't basically restructure their economy to make it more competitive and productive, then it's simply not going to work. It's simply going to have to some way restructure its debt, and the economy won't grow as a result of these other reforms or the other arrows in policy. So Japan's in a really interesting place. So these proposals are being put to Abe. Some of the reforms are being watered down and going through, but it'll be 6 to 12 months before we have a clear picture of where these reforms go. And at the end of that period, either one or two things will happen, or during that period. Financial markets will believe that the reforms are going to work and that they'll continue to reform and that the debt level will stabilise and eventually come down, or people will give up on Japan. And what that will mean is people will pull their money out of Japan, the Japanese exchange rate will collapse, the population will collapse, the debt, who knows what will happen. But Japan is, I think, an accident. It's kind of waiting to happen because I'm not sure they'll be willing to do enough to get them out of the place that they're in. So that 200 odd % debt to GDP ratio in Japan is a real big problem.
How large is the money supply currently? So if you're saying they're going to double the money supply and buying back debt from the banks.
Yeah, so I mean the advantage that Japan has, which Greece doesn't have, is that the Bank of Japan can buy Japanese government bonds and just bury them, and that's one way of getting rid of debt. That would lead to inflation. So I mean that's probably what will happen, is that the Bank of Japan will have to buy government debt, and really just, they won't say it's written off, but they'll have no expectation that it will ever be repaid. And they'll print money, and that will inflate their way out of that difficulty. So I think for face reasons, that's the most likely outcome in Japan. But we'll see what happens. I guess the optimist in me hopes that these reforms are more radical than anything that's happened in Japan in the last 20 odd years, and they do reshape the economy. But it's a very difficult economy to manage because the workforce is declining so significantly, as well as this public debt. So, the public debt's a big enough problem as it is without having the workforce decline by 40%. So you've got 40% less people to carry it. Yeah.
What do you say to people who say that per person GDP, their growth rates have been lower in Western Europe, the US and so on?
That's not correct. I mean, per capita, it doesn't look so bad. And it doesn't look so bad, certainly compared to Western Europe in recent years. But it looks bad compared to Australia or the US or other countries. Now, the one thing you would say about Japan is that it's not poor. Right? So basically it's a rich country, but it's just not getting richer. It's a rich country that's getting older. And so you might just say, well, this is a country in, sort of described in the Financial Review as a country in genteel decline. It's not in some sense it's not a really sad case, but it's not a really happy place either. So that's Japan. So the critical thing is what happens with these arrows. I've got there that they won't work, but we'll see about that. And I should say as well, in terms of their objectives, they're aiming to achieve, they're aiming to achieve 2% real GDP growth and 2% inflation. That's 4% nominal GDP growth. That would help a lot in terms of stable, or at least stopping the debt from growing too quickly. But I think they'll get the inflation, but I'll be very surprised if they get anything near 2% real GDP growth. So nominal GDP growth will be more like 2 than 4%. And as we know in Australia, it's the nominal GDP growth that drives tax revenues and makes Wayne Swan very upset and all those kinds of things. All right. So that's Japan. And maybe I'll move on to a place where at least I'm not with the bears. I don't know that I'm with the bulls either, but I'm not with the bears so much on China as I am with Japan. So let's talk a little bit about China. I might skip through the first few slides because I think many of you will have seen me talk about China before in terms of how they've gotten to where they are. The real questions about China are where are they going now and in the next 5, 10 and 20 years. So how did China get to where it is? Well, China's a fairly familiar story, and this is where the bulls and the bears agree. Basically, this is a well-worn path. Countries grow quickly because they're poor and they invest a lot. And so China is following the same path that Japan, Korea, Singapore and so on followed earlier in their histories. So there's nothing miraculous about what's happened in China in the last 30 years. The reforms in China started off with reforms that meant that agricultural productivity grew very quickly, then industrial productivity. And I guess one question that I have in my slides here is the sort of, in terms of the phases for the economy, you reform in agriculture and you get agricultural productivity. But ultimately, agriculture is not much help to the economy. In Australia, agriculture is about 3% of GDP and 1.5%, 2% of employment. So it's not a big, it's important, but it's not the be-all and end-all for our economy by any means. Industry is important, very important now for China's economy. But again, in Australia, industry is important, but services is where all the action is in most advanced economies. So China is on the point of moving from an economy where industry and the industrial base has been driving growth, but it's services where all the action is in the future. And in the services sector, to get productivity, you need innovation. And this is the sort of key challenge for China in terms of the next phase, is where that innovation will come from. Can they drive growth in the services sector in the same way as they've done in industry? So that's one of the things I want to pick up on in a moment. Over the last 34 years, so reform began when Deng Xiaoping took power. Over the last 34 years, GDP growth's been more than 10%. On average, I think it's 10.5. That is a bit higher than those other countries historically, but not orders of magnitude different. Again, investment growth is a key part of the story. So compared with Japan, so 11%, that's doubling every 6 or 7 years. So over 35 years, I don't know, what's that? 15, 16 times the increase, or the investment levels, 15, 16 times or something like that, what it was in 1980. And net export growth, I probably should have export and import stripped out there, but exports have been a very important driver of GDP growth in China's economy. But I guess as an economist, I tend to focus more on investment as the real driver of growth. And consumption has kind of lagged. So there's a couple of reasons, there's a couple of stories there. One story is the consumption data is mismeasured. So consumption growth is probably a lot closer to GDP growth. It's mismeasured because they ask people in China they ask people how much money they spend, and people lie about that. Why do you lie about that? Cash. People are worried about the tax man. The consumption growth is probably more like 9+%, and today consumption is a big driver of China's economy. So mismeasurement of consumption in China is a big problem in terms of interpreting the market, and for Australian companies entering China, you should be much more optimistic about consumption growth than what you see in the numbers. And I don't know if Mark Ritson talked about China this morning, but the LVMH guys up in China think that it's the best place on earth. Well, it is for them, because consumption growth is growing very strongly, and they see it continuing to grow. Yep.
Can they actually measure consumption growth, like by stuff that the people buy? Because I heard, like, in China, because they can't really take their money out for the middle class, at least. That's why they've been buying up real estates over there, like all the apartments. That's why it's like all.
Yeah, so I mean, the way you can kind of reconcile the official numbers with what's going on in the economy is by looking at things like that, and that's why we kind of think that consumption growth and the level of consumption is much lower than is stated. So in the stated numbers, one of the issues, I can't remember if I've got this on the slides, but one of the issues at the moment is investment in China is about half of GDP, and that's too high. There's no question that's too high. And so the bears on the China story say that there's too much investment. You may have all seen the pictures on the front page of the Financial Review of 2 or 3 weekends ago of the empty cities in China and the empty buildings. And so that's a reflection of this excessive investment. I'll come back to that in a moment. The fact is, with consumption being much higher than it is, both in levels and in terms of growth rates, the investment share is actually lower than that 50% number. Right, so anyway, we kind of know that these numbers are wrong. Yeah.
How much investment is foreign investment, and what is the trade with foreign investment?
Yeah, so remember, investment is what firms are spending here for investment purposes inside the economy in total, right? So that's a separate concept than sort of foreign investment, but some of this investment will be funded in a factory that's foreign owned. And I'd need to check, but the last numbers I saw were about 15 to 20% of investment is in foreign-owned companies, so you can think of that as foreign investment funded. Yeah, so it's important, but it's not, it's not 50% or anything like that. And where it is it's either, a lot of the investment is either in foreign firms that are investing, or it's in state-owned enterprises that are investing. And that is another problem in China, is the state-owned enterprises are doing a lot of the business, full stop. Yeah. Okay, so it looks very different here to the story for Japan. I guess one question you might have is, why do we talk so much about China and not talk so much about India, which soon will overtake China in terms of population? Well, it's interesting. I didn't realize this until I gave a presentation comparing China and India a couple of months ago. And at least you see some different data, but in the data I had, for every year since India started reforming in 1990, China grew more quickly than India. So yes, India has sort of sped up its growth, done some of the same things that China has done, but it's had a lot more difficulty generating investment, infrastructure investment and so on. And so where China's been growing at 10%, India's been growing at 7%. And when China slows down in the financial crisis to 7%, India slows down to 4%. So India, because it's been growing more slowly than China for so long, is now only about a half or a little bit less than half the size of China's economy, again, depending on how you measure it. But for any sort of measure in terms of economic impact globally, India is a much smaller economy than China. And for India to, I guess, increase its economic weight, it's got a long way to go, and I don't think it'll get there certainly in the next 5 years or 10 years. I'll come back to some of the issues around that in a moment. But the reason we don't talk so much about India is basically it's much smaller, has much lower levels of investment than China, and China's had much faster productivity growth than India. The characterization is China's been about moving a few 100 million people from farms to factories. And so that foreign investment is funding the building of a factory, electronics, clothes, etc. And there's literally hundreds of millions of people over the last 30 years have moved from the countryside to initially around Guangzhou, but then all over China. And they're working in factories. They're making stuff, a lot of it for export initially, but now increasingly for internally in China, other parts of Asia, as well as export to the US and elsewhere. So that's the characterization of China. The characterization of India and its growth has been IT and outsourcing and that kind of stuff. The problem with IT and outsourcing is it doesn't employ 300 million people. So in India, they haven't created the industries or the industrial base that would move hundreds of millions of people from farms to factories. And so India has a major problem in terms of moving people out of poverty and in terms of generating growth. There's nothing wrong with IT and outsourcing, but it just doesn't create enough jobs to power an economy the size of China or India. So that's a major challenge for India. How do they get, now the sort of position that this is now in is India has the opportunity to take some of this space from China because China's getting expensive. But the big question is whether India will do that or whether it'll go to other parts of Asia, which is basically what's happening now. Clothing and electronics are moving out of China because China's too expensive to Thailand, Vietnam, other parts of Asia, but not so much to India. So the key challenge for India is how do you create an environment where foreign investors want to invest? How do you build the infrastructure that supports that investment and so on? And India has major challenges in terms of getting there. All right, so that's the story here really in terms of investment. And of course, the other challenge for India is there's lots of new interesting places popping up like Myanmar. If anyone's interested, we've got an alum doing some very interesting things up there in terms of investments in agriculture. But there's lots of opportunity around the place. The critical question will be, for China, to what extent will investment slow down? And for other countries, to what extent will investment pick up and support economic growth? Now for China, this productivity story is a bit of a challenge. They've moved a couple of 100 million people to these factories, but now people are on middle income wages. And so either the factories have to become more productive and do more high-tech stuff, or people are going to lose their jobs. So the government's objective in China is to push the economy into higher tech. So supporting that by having a better education system, people are more educated, doing other things, the other infrastructure that's necessary. But this is a big risk for China. Right? Are they moving too quickly in terms of pushing the economy away from sort of low tech towards medium tech and eventually to high tech? Now, China's actually following a very similar path to Singapore. Singapore was another economy that actually pushed the economy from, in 1965, it was basically the same as China in the 1980s. It was low-tech clothing, electronics and things like that. Then the government basically pushed those industries out and supported things like finance and now biotech and things like that. And it's interesting, Deng Xiaoping, when they started reforms in China, went to Singapore and copied some of the special economic zones and other policies of Singapore. So it's interesting that now they're also following a path that has worked, but is very risky. They're pushing the economy to its limit in terms of its ability to create jobs in medium tech and ultimately high tech, rather than sticking with what they know and doing it well. So some of the things the government is doing is allowing, supporting, pushing wages up by 10 to 15% each year. So they've announced, basically the Human Resources Ministry has announced that they want wages to double every 5 years, or in the next 5 years. So wages did double when they made that announcement a couple of years ago, and the expectation was from 2011 to 2016, wages would double again. So that, of course, is hugely challenging for companies that are investing in China, and you don't see clothes made in China anywhere near so much anymore as you did 10 years ago. So that's the challenge with productivity. And I thought I'd mention this. I suspect most of you don't know this. For those of you in the technology game or those types of spaces, high-tech spaces, this is a big problem. China has decided to move from low-tech to high-tech, and they've announced a new policy. It's actually an official policy that follows on from one of Deng Xiaoping's official policies, which was reform and opening. So he said they were going to reform the economy and open up to the world, which happened through the last 30 years. The new policy is innovation with Chinese characteristics, it's been called, or indigenous innovation. So they know that to keep the economy moving and to have the productivity growth that we need to support economic growth and to support jobs, we can't just rely on moving people from farms to factory anymore. So what do? Well, if you're at the American Chamber of Commerce reading the indigenous innovation policies in China, you say, you do what China always does, you copy things. All right, which is what the quote, this is the actual quote from the Chinese government translated. So what this indigenous innovation policy does is it enhances original innovation through co-innovation and re-innovation based on the assimilation of imported technologies. So that's official policy. So it's very interesting. Now, I guess obviously, again, if you're in the IT industry or something like this, you should know about this. Read the American Chamber of Commerce report on this. It's a fascinating report. And it has major implications for doing business in high-tech businesses in China, because the government policy is basically people are allowed to rip you off. For me, the big question about this is whether it'll work, right? Whether it will work to stimulate indigenous innovation and to support economic growth. And I guess the thing to me is that this might work for a couple of years, but China is very big. Ultimately, for it to grow, it's got to be innovating itself. And so parts of this policy have been aimed at doing things like bringing Chinese researchers back to China from mostly the US, but elsewhere as well. And those policies have been quite unsuccessful, for reasons that we would all understand, because it's not very attractive to work in a Chinese research lab with no independence and intellectual freedoms and so on, as opposed to working in a US lab. So those things are very important to researchers, and I think that the Chinese policy might not be as successful as the government is hoping in terms of driving innovation and driving economic growth. And so this is a key open question in terms of China's growth looking forward.
If you look at their patent rates and their publication rates, they're all going through the roof.
Patent rates are going through the roof, but that's one of the interesting things here too. A lot of them are what patent lawyers in Australia would describe as junk patents. And the other thing is, you don't have to, under Chinese patent law, you don't have to have the original idea, you just have to patent it first. So if someone else has an idea and you patent it, you've got the rights. So there's some big issues with those Chinese patenting numbers.
And their $1,000 program, which is to what you're talking about.
Yeah.
Taking expats back.
Yep, yep.
Huge grants that they often do.
Yeah, but I think, Singapore, when I first started working in Singapore as a consultant in the central bank in 1998, they had just introduced a foreign talents program where they were aiming to, they had a policy where they'd pay Nobel Prize winners $500,000, and 15 years ago that was thought to be a lot of money, enough to attract Nobel Prize winners to Singapore. And anyway, they had this foreign talents policy aimed at bringing talented foreign innovation workers in biotech and so on into Singapore. Now, it took a while for that to work, but eventually it worked. They have very advanced industries in biotech and things like that, pharmaceuticals. And I think it works in Singapore because, we could argue about the politics, but at least in terms of intellectual freedom and research freedom, it's a very easy place to work. Whereas certainly China at the moment is not where Singapore was 10 or 15 years ago. So whether that 1,000 talents policy will work or not, I think is still an open question. Okay? So this is a really interesting sort of medium to long-term issue for China, is how does innovation play out? The more immediate issue in China, and I'll skip over a couple of slides here, the more immediate issue in China is things like basically this battle between the bears and the bulls. How will excessive investment in real estate and more broadly across the economy play out? Is there a bubble? So let me tell you the bubble story and then give you my take on this. So in China, investment's been 50% of GDP. What does that mean in terms of the economy? Well, lots of cranes out there on the horizon, lots of investment by mostly state-owned companies, but state-owned companies are in every part of the economy. So they're in everything from restaurants to construction to, you name it, hospitals, etc. So it's the sort of investment that we would see in Australia. It's just that some of it is state, at least state-owned enterprises doing the investment, if not sort of state-sponsored. There's no question some of this investment is a problem. So I Googled, I forget what I Googled, but I Googled something like China property bubble, and there's tons of pictures that you can put up of empty apartment buildings. And those of you who've been to Shanghai with me will have seen some of this around Shanghai, but not much. And the story that was in the Financial Review a couple of weeks ago was of a new city being built across the bay from Tianjin. So Tianjin's Melbourne's sister city, and a population of around 10 million. And they're building a new city at the moment it's about 400,000 people, expected to be about 4 million people at the end of the project. So they have an occupancy rate of 5% at the moment in the completed buildings. And you look across and no lights on, all those types of things. Is this a problem?
Well, I just went through China recently. I went to Chengdu Airport.
Chengdu, yep.
It's 288 bays, and we didn't even park our plane in the system airport. It's massive. Obviously built for the sort of future. And then I went to Shangzhou, and that's a city that was farms in 1998, and now it's a city bigger than Sydney. And there was people everywhere. So they're going to build for the future like this. You can't get it right every time.
Yeah. So this is the main point. So in Japan, it's already urbanized. It already has the infrastructure. People aren't going to move to a new city, and you've got less people in the future. Now, China has an issue because they will have less people in the sort of 20 to 30 year future. However, China is still urbanizing. It's only just past 50% of the population in the urban centers, and that'll probably go to 60 or 70%. Again, in the case of China, you've got another 150 to 200 million people who are going to move to cities. And China still has some controls on where people will move, so they can't all go to Shanghai and Beijing. So they're building new cities as well as expanding existing cities. And I guess the point Tim's making is that these new cities, they're building for the future rather than building for today, and eventually they'll get filled. Now, I'm sure some of these things will be duds, but they're much more likely to be occupied and productive than would be the case if you saw this in Japan. Now, the second issue is to what extent is this financed by credit, right? The story of the global financial crisis is arguably excessive building, but certainly more building than was normal in the US. But it was funded by credit, by people borrowing 100% in terms of the loan to valuation ratios, and they're not paying down that loan very much. In China, in the housing market, people don't borrow to build houses, right? So typically people pay cash or they borrow at most 50%. So in the residential apartment market in the big cities in China, probably prices are overvalued, probably there's too much build. It could end ugly for some property developers, but I think in terms of the overall sort of economy-wide implications, I don't think it's a disaster for China. And the other forms of construction investment are, again, I think mostly likely to be filled because of China's urbanisation. There's a lot of credit-fueled growth where state, provincial level governments are borrowing from banks that are sponsored by the state and probably over-investing. And that's where I have a lot of sympathy for the views of the bears, that some of that investment will turn out to be ugly. So a lot of infrastructure construction has been built with heavy borrowings and SIVs, so state-sponsored investment vehicles to fund them, and some of those vehicles are likely to go belly up. And if you look at the credit numbers for China, economy-wide credit has grown very quickly since the financial crisis. So there's no doubt there's some problems in China with credit and with excessive infrastructure and building, but I think they're manageable problems. That's the bottom line for that one. And we can talk a little bit more about that one. And the shadow banking is the kind of structure that has been put in place to fund these types of building. Yeah. Yep.
Probably a stupid question, but if all the farmers are really old and they're moving everybody to the city, where's the food going to come from?
Well, luckily agriculture is a lot more machine intensive or capital intensive than it used to be. And like I said, in Australia, we've got 3% of output producing plenty of food for us and for export, and only 2% of workers. And with all that capital, it doesn't matter if you're old, you can still drive a tractor. So it's not like 50 years ago where, you know, farming was really hard work. So in China, I think there's no fear that they can feed people with a lot fewer people on farms. There is a lot of fear about what you get off those farms in terms of ultimately food that is of dubious quality, but they can feed people. And that's where there, as many of us know who've been to China and done projects in that space, lots of opportunity in the food space in China. But good, clean food, basically. Now, I'll finish just on these couple of points about China, and again to come back to India as well. In terms of thinking about the next 20 odd years in China, I think it can still, the current plans are for it to grow at 7% in the 5-year plan, and probably that'll slowly slow down over the next 20 years to maybe 6%. So, but I think China can achieve that kind of growth over the next 20 years, 6 to 7.5% in each 5-year plan over the next 4 5-year plans from now till 2031. So that's going to double their GDP roughly every 10 or 11 or 12 years. And again, in terms of China's position globally, it will clearly be the biggest dominant economy by the middle of next decade. There's a couple of risks there. Obviously, China does have demographic issues. Right? So it's got one-child policy since 1976. It's actually still behind Japan in terms of the age of the population and so on, but it'll catch up over the next 30 years or so. So the argument is China is the first country to get old before it gets rich, and what are the implications of that for the economy? Well, I mean, the implications are, if you have an older economy, you've got challenges in terms of healthcare. There's a major one. You can't afford to have a very expensive pension system, is another issue. You have to have people not retiring at 65. When people started to retire at 65, or when there were public-sponsored pensions at 65, male life expectancy was less than 65. Right? So it wasn't very expensive for the government to promise pensions because not many people got there. Right? Now, you guys are going to live to be 100. So that's 35 years on the pension. Basically, the pension system was set up on the assumption that we'd have a growing population, most of whom would be dead by the time they reach 65. so pensions aren't expensive. When you've got a shrinking population and people live to 100, pensions, as we currently have structured them, are unaffordable. So China's advantage here is they haven't set up a pension scheme of any generosity yet. And they'll know, public pensions are for when you're 70 or 72 or something like that, not for when you're 65. They won't be generous. And the other thing that China has as a sort of clear opportunity is that education levels in China are okay, but there's still a lot of room for growth that's sponsored by better education. And so the average number of years of education is still only about 10, and the tertiary system is growing very quickly and is in some cases of quite good quality. But there are lots of opportunities in the educational sector, both as a sector, but also to support a better educated workforce. And again, if you compare that with Japan, that opportunity is kind of not really there. Right, so I'm not so pessimistic about demographics and China as I am with demographics in Japan. I think China can manage some of the very challenging issues it has in the next 20 or 30 years around demographics. The other thing that some of you may have seen in The Economist magazine had a nice piece on this. They were arguing that India's growth will outpace China's because of demographics. Now again, I would argue that in the case of India, yes, they've got lots of younger people, but they have a real challenge educating them. So I'm not convinced that India will be able to reform its education sector to keep people's education level growing quickly enough to support economic growth. So I'm not convinced by the demographic story for India, but that was the Economist argument was they have an advantage because they have this huge young population in India. And the second argument also starts with D, was about democracy. So the natural advantage of democracy in terms of generating economic growth. Now interestingly, in the economics literature, there's no clear correlation or causation between democracy and economic growth. And if you think about it, I mean, as economists, we know that the best form of government is a dictator. As long as they're benevolent, a dictator is the best form of government because they get things done and they get the right things done. Now, China is not a benevolent dictatorship, but it is a dictatorship that gets some things done right as far as economic growth goes. Whereas India, of course, has democracy, but in terms of building infrastructure, in terms of getting approvals and so on, it's a very messy place. And what we're seeing right now, the reason the Indian currency is falling so dramatically as we speak and in the last couple of years is because of a lack of confidence in India's government to do things that support economic growth and support foreign investment and so on. So in short, democracy could be an advantage, it could be a disadvantage. It really depends on the quality of government rather than the form of government. I know some of you have heard Sam Wiley arguing with me on this one, but it seems to me that it's the quality of the government and what the government does rather than the nature of government that's more important for the economy. There are lots of other reasons why we would want democracy, but in terms of economic outcomes, that argument is not clear. Peter?
What do you see as the level of corruption in both?
Well, so corruption, and this is the other point that some of the bears on China would make, and I should tell you, China and India, in terms of measured corruption, and any of you who've done business in either place will tell you, basically are about the same level. Right? So Transparency International measure corruption and different ways of measuring that, and they put both China and India as high corruption countries, and that seems to me to be right, in my experience. So corruption, and the argument is that at some point corruption becomes problematic in terms of supporting economic growth. And I do think that's right. I think that corruption is a major challenge. And it'll be interesting, the current government in China is taking measures to reduce corruption. How committed and how successful they are, we'll see. I think corruption will fall, but I wouldn't bet on it going away. To what extent that limits growth, I'm not really sure. It seems to me like, in some sense, people know how to do business in China. Right? They know how to deal with the corruption. For us, it's a lot more challenging in entering a market like China or India, but the Chinese kind of deal with it. But that's a really interesting issue for both of these two countries. Yeah. All right, so let me just, I might skip over the US quickly to come to to end on talking about Australia. So let me just sort of address these questions and give you my take quickly on all of these. I had a 7-minute TED talk that I was going to show you, but I haven't got time now. But if any of you want to have a look at the TED talk by Robert Gordon, Robert Gordon's a very well-known economist, and he argues, basically he gives the story as to why it is possible, and he doesn't argue this is likely, but just why it's possible, that productivity and growth in the US in the next 50 years might be 0.2%. And what that means is that economic growth in the US is probably only going to be about 1%. So going back to what we saw 150 years or so, 100 years or so ago, and prior to that. And his argument is that essentially productivity comes in waves. And in the US, in Australia, we had productivity because we had a transport revolution with the horse and buggy to automotion to airplanes and so on. We had a productivity revolution because we had electricity. And electricity was a huge boon to manufacturing. And most recently, we've had productivity growth and the productivity boom because of IT, because of computerization. And his story is that these kind of booms or these waves aren't guaranteed to continue to occur. These are sort of big step changes in the way the economy works. And by their nature, we don't know if they're going to happen or not, right? We can't say, I know that the next thing is going to be da-da-da, because we don't know what it is. But because it's not guaranteed, his point is if we don't get some kind of step change like that, that will reduce productivity in a very significant way. But absolutely. So those waves in terms of productivity are almost the same in Australia, the US, Canada, Western Europe, and so on. Yeah. The other thing that he says is that things like demographic change are going to weaken economic growth and productivity as well. So the sort of theme I've already picked up on. The other issue, of course, in the US is they've got problems with public debt. That's going to be a drag on their economy. Right at the moment, someone earlier asked me about the US. The US is showing good signs in terms of economic growth and recovery. And what is good and different about the US as compared with Japan is all of the growth in the US is private sector driven. It's private consumption and private investment. So that's going to support ongoing economic growth. And ironically, the government sector in the US is actually a drag on the economy. So you might think, well, why are they doing that? Well, they're doing that because they've got a bit of a debt issue. Right? But what I would read from that is, well, this is a good thing. Their economy is starting to grow. That'll grow their debt problem away. And as it was private sector driven growth, it should be ongoing sort of sustainable economic growth. So the US is in still a bit of an ugly place in terms of the labour market and so on. But in terms of economic outcomes, it's getting better.
But that's what Krugman would say, right? And that's driven by money printing from the Fed, right? So pretty much all the growth since 2008 has been driven by printing those cash that continue to do so.
That's right. So one of the one of the really difficult issues for the US is what happens when they reverse quantitative easing, right? When they stop this money printing. And I won't go on because I want to quickly come to Australia. The short answer to your question is I think that's right. I think that the quantitative easing has been a big part of the story, but it's not the only part of the story, and I think they can sustain growth even when the quantitative easing goes away. So, I mean, I don't know what Krugman would say on that, but that's my take on that one. The other thing that's on this slide, which is related to the Gordon story, is what's his name at PIMCO, Mohammed Al-Arian, has argued that we should expect to see lower economic growth in the future in places like the US. And I wouldn't necessarily be this pessimistic, but it is the case that demographic change is going to reduce economic growth in a lot of countries. So maybe instead of the 2.5% to 3% that the US normally gets, maybe expect 2 or maybe even 1.5 to 2 in coming decades. Europe, forget about it. That's the problem, right? That slide there is the problem, and it's still going to be a problem. As I've said, they've just had their first positive growth number for 6 quarters, but it's a disaster. So let me finish on talking about Australia. So I don't know if I've got this on the slide, but where do I see Australia in all of this? Well, again, we're hitched to China, so the China story is critical for us. My take, and again, you read the miners are kind of not as pessimistic as some of the media reports seem to be on this. China, in terms of demand for resources, so because they're still building infrastructure, is not going to go away. So yes, commodity prices will be volatile, but at least in terms of export volumes and sales revenues and so on for the big miners, I think that the outlook is pretty reasonable for the next few years. All right, so that's, in terms of the economy, that has major implications, right? It shouldn't be as weak as some of the pessimists fear in terms of Queensland and Western Australia. Now, the difficulty is we have got this issue with an overvalued exchange rate still. So 92 cents is still above kind of the fundamental value for the Aussie dollar. So that is a problem for Victoria, for New South Wales, which are more export oriented in terms of manufacturing and so on. So that problem is not going to disappear. The two-speed economy, if you like, we might think it's gone because the mining boom is slowed down, but it's still there as a result of an appreciated exchange rate and related issues. Productivity to me is a key story that both sides of politics talk about, but they quite clearly don't understand. So in the Asian Century White Paper, it was stated over and over again that Australia needs to be a more productive place if we're going to compete in the Asian century. And that's absolutely right. But what does it mean to be more productive? Right? What do we require to be more productive? We require a better education system. We do require much better infrastructure. And we seem to be in a very ugly place on that front. And we need a competitive economy. And in terms of implementation of policies that get us to those places, I'm not sure that either sides of politics, I'd give them a tick in the current election campaign. So things like a 20% tax rate in Northern Territory don't deliver on that.
My question was going to be, saying we need a more competitive economy is a bit like saying we need better productivity, and I was going to ask for examples about that, of that. What does a more competitive Australian economy look like?
Obviously it depends on what sector of the economy you're in, but let me give you a couple of examples. I'll give you one example given the time. And this is because it's thinking about where Asia, I'll give you two examples, thinking about where Asia is going. In medical care, so all countries have issues with delivery of efficient, effective, but also lower cost medical care. And the problem is in Western countries, we've got an ageing population who vote, and they're voting for good quality healthcare, and they're voting not to pay for it. And again, 50 years ago, that wasn't a problem because we didn't have many old people. And so we could afford to give free medical care to people over 65. But today, it's unaffordable. And so what you see in India, the example I gave in my classes a couple of weeks ago, in India, heart surgery costs between 10 and 40% of Australian, 1% of US costs to do open heart surgery. The outcomes are just as good as in an Australian hospital, if you go to the right hospital. All right, the outcomes are just as good because they've taken Kanan's class and they set up the hospitals like a big production line. The doctors specialise and you've got a big population, so they take advantage of scale and they train people well in a very narrow area, and they're thinking about low cost, high quality outcomes. All right, so there's an example of how in Asia people are doing things differently because they're not coming from our perspective of we need the best healthcare no matter what it costs, right, even if it's unaffordable. In education, so we have the Gonski reforms, who knows where they will go, but that's centralised, sort of top-down. I guess I have some fundamental problems with that approach to education. Interestingly, Shanghai you might think would have a very centralised top-down structure, but in these PISA tests, these tests of math ability and so for 15-year-olds. Australia's middle to bottom of the pack, I think. Shanghai has been top in the last couple of sets of tests. Shanghai has a very decentralized education system. They've experimented in the way that China has experimented with lots of reforms. They have allowed mentoring, so good schools, teachers have to mentor bad teachers from schools that aren't doing well, not bad teachers. And not only that, but the sort of heads of school have to mentor one another and discuss what works and what doesn't work. You send kids from a good school to a bad school and vice versa. So very interesting and innovative approaches to education and to the curriculum. And again, I think trying to deliver in a lower cost, more effective way rather than thinking about we need to deliver this outcome. Let me finish there because I'm sorry I didn't probably spend as much time talking about Australia and the issues as I intended, but I can happy to do that over a coffee or whatever in the break or at the pub. So thank you for your time. It's great to see you all back. Thank you.